I've been trading for over 7 years, and during that time, I went from starting with nothing to trading full-time for a living. And in today's video, I'll break down the easiest way to start trading as a complete beginner, step by step, and exactly what I would do if I started from scratch. By the end of the video, you'll learn a proven system and strategy that I use to become a consistently profitable trader. The best part is, no matter if you're a complete beginner with a few $100s or an expert, you'll have all the tools you'll need in order to succeed in the markets. So if you're excited to learn, make sure to hit the like button below and let's get right into the video. Okay, so first let's set out the foundation and the outline of exactly what we're going to be talking about in today's video. I want to go over exactly how trading works and what we should be looking for in the markets. So first we're going to set out on the foundation on exactly how the markets move and how they form. Then we're going to talk about the different types of websites and tools that I personally use on a day-to-day basis. Then we're going to talk about trading psychology and why trading psychology is so important when it comes to trading in the markets. And then we're going to talk about my bread and butter system and strategy. And then we're going to end it off with money and risk management. So I know there's quite a few things that I just outlined, but that's why I'm going to break it down step by step. And we're going to take you through the full process from the foundation to the risk management. And we're going to go over every single step in depth and why each single step is important for the overall foundation for our trading and how we can ultimately become profitable and consistent traders. Okay, first let's set the foundation straight and understand the goal of trading. There's so many different systems and strategies out there. When you first start trading, you might be a little bit confused because there's so many things to look at. But we're going to break down the very basics of what trading is. And ultimately, what trading is understanding the balance between buyers and sellers. And this is the very basics of how markets move. So what we have in the markets is we have some buyers and we have sellers. Right here, you can see prices pushing towards the downside. What does this mean? That means sellers are in control. And when price ends up pushing higher, that means buyers are in control. It's a concept of supply and demand, and that's exactly how the markets move. So as you can see, the markets are made up of buyers and sellers. The chart that we have in front of us is a line chart, but it's basically a visual representation of the buyers and sellers. It's human psychology plastered onto a chart. So as you can see, price moves up and price moves down. When price moves down, that means that sellers are in control. That means there's more supply than there is demand, pushing price towards the downside. Whereas when price is moving higher, as you can see right here, that means there's more demand than supply, pushing price higher. And then the same thing, once price ends up reversing, there's more supply than there is demand, so it pushes price back towards the downside. So this is the very basics of how markets move. It's basically classic supply and demand. So as you can see right here, what we have is what's called a demand zone. So price is bouncing off this key level of demand, which is also fair value. This is what buyers are willing to pay. That's why buyers are stepping in and pushing price back towards the upside. So this is what's called demand, and this is where we want to be buying. This is where there are more buyers than sellers pushing price towards the upside. On the top, what we have here is supply, and this is the exact opposite. This is where there are more sellers than buyers, so we're pushing price back towards the downside. So this is what's called supply and demand. So this is how the markets facilitate through retail orders, through institutional orders. This is how the markets move. So with that being said, we understand the basics of supply and demand and how the markets move. So what is the overall goal of trading? And the goal is, of course, to make money. So in the most basic sense, what we're doing is looking to buy an asset and looking to sell it at a higher price. So for example, we buy something that is $100. This can be stocks, this can be futures, this can be options. We're looking to sell it at a higher price. In this case, let's say price rises to 110. This is an increase of $10. So that means we bought something at 100, sold it at 110. We made a $10 profit, which is very good. Some of you guys may not know this, but we can also sell at a higher price and buy back at a lower price. So the overall objective is to make money. And to make money, what we got to do is buy low and sell high, which gives us profit, right? We want to make money in the markets. As you can see right here, what we have a chart of is the S&P 500, and this is the past 2 years. So we're on the daily chart, and this is 2 years worth of price action. You can see the markets have plenty of different opportunities. We go down, we go up, we go down, we go up. You can see there's so many different opportunities here on the S&P 500, but overall the markets have been gravitating higher. And on an average year-to-year basis, we move about 10%. In the past couple of years, the markets have been very volatile, so we've been moving about 20% per year, but this gives us a good understanding of how much the markets move. And of course, if you're investing or you're long-term trading, 10 to 20% is substantial gains, specifically if you have a large amount of capital. But as day traders trading on the lower time frames, we're looking to capture momentum moves on the lower time frames. We're not looking to invest for years on end. We're looking on the lower time frames to capture those intraday movements. So as you can see, we're on an example here, which is on Intel. This is a trade we took recently. And as you can see, we're on the lower time frames. We're on the 1 minute chart. So we just went from the 2-year chart on the S&P 500 to an Intel chart, which is on the 1 minute time frame, which just happens to be on one single day. And as you can see right here, the trade that we ended up taking here on Intel, you can see the stock price rose up about 5%. We moved about 2 points on the underlying, and that meant that the stock rose in about 30 minutes up 5%. So if you're able to capture these type of trades, and I'm going to show you exactly my strategy and my system, and if we're able to capture these type of trades on a consistent basis, you can see the type of gains that we can get on Intel while risking a very minimal amount. And this is what day trading and trading on the lower time frames is about. It's about capturing momentum moves in the markets where you can make a lot of money in a very short period of time. We'll talk about risk management, we'll talk about our system or psychology here in a second, but this is the overall purpose of day trading and what our objective is as traders. And as you can see right here, this is exactly my executions. And as you can see, I end up making $13,000 on this day while only risking $2,000. So I had to realize our multiple of 5.67. So that means for every single dollar I was risking, I ended up making over $5.67. And this is on one single trade within 30 minutes. And I want to mention that this is not to show off or to brag at any means. This is just to show you the possibility and the power of day trading. In this case, I was trading options, so it is leveraged. And as you can see, the contracts move from $1 all the way to $2.80 and above. Each contract costs $100. You could have turned this into $280 within about 30 minutes. You can see how powerful it is capturing these higher time frame moves using these proper instruments. And this is exactly what I want to teach inside of this course. I want to show you guys my system, my strategy, exactly what I look for, and the power of day trading. So with that being said, now let's go on to the websites and tools that we need to learn how to trade in the markets. Now let's talk about the tools that we use every single day. I just want to mention that everything that I do talk about is linked in the description below. So if you want to check it out and use it for yourself, you can do so. And the broker/charting software that we're going to be using that most people use is called TradingView. So we'll talk about the TradingView charts, exactly how we can use it, how we can set it up. And the broker of choice that I'm using in 2026 is Moomoo. If you do want to use this broker, you can use it for stocks, options, and futures. It's available in most countries. This is one of my preferred brokers in 2026. So with that being said, let's hop onto the TradingView chart to show you guys exactly how to use this. As you can see, we have the TradingView website pulled up. This is a very basic charting software. Most of you guys probably already know what this is, but I'm going to show you exactly how to use TradingView. So where you want to go is down to the products section, and you want to click on what's called the super charts. So once we click that, this is what will pop up. This is the default layout here on TradingView. And as you can see, if we go over to the left-hand side, you can see the ticker that we have, which is Apple. It shows the ticker, it shows the time frame. If you want to switch the time frame, you can go on to, let's say, the 1 minute time frame. You can go on to the 5 minute time frame. You can go on to the 1 hour time frame. So you can toggle the time frames depending on what type of trader you are. If you want to search up the different type of instruments, let's say, for example, we want to trade gold, we can search up XUA USD, and this pulls up the gold chart. If we want to trade the SPX, we want to trade Tesla. There's so many different types of trading instruments that you can use. So right here, what we have is what's called a candlestick chart. So you can see candlestick candlesticks towards the upside. You can see red candlesticks. You can see green candlesticks. You can go onto the top left-hand corner, and some people have what's called a line chart. So there's line charts, there's bar charts, there's candlestick charts. This is the most basic, is the candlestick patterns. We'll kind of talk about the basics of candlestick formation and what we look for. But when we're going over TradingView, this is just a very basic layout. What we have on the left-hand side is our tools. So if we want to draw trend lines, we want to draw boxes, you can do that. And then on the right-hand side, of course, what we have is our watch list. So we can create a watch list where we can be looking for certain individual tickers. Now let's go on to my personal TradingView layout. So as you can see right here, I have my personal TradingView layout customized to my own liking. The colors of the candles are a little bit different, but they're still the exact same. As you can see right here, what I have are my favorites. So I can draw trend lines, I can draw all boxes and rectangles, I can type text if I want to. So this is the favorite section. And of course, this is all on the left-hand side. And on the right-hand side, what I have here is my watch list. So I'm going to quickly break down my watch list. You guys can copy this watch list if you like, but it's broken down into features. So I have the ES, the NQ, the YM. I have gold, silver here as well. I have the major indices. So I have the correlating feature to the ETF. So I have the SPY and Qs. And then I have tech stocks, which are made up of the Meg 7. So big tech companies within the S&P 500 and the NASDAQ. So things like Tesla, Nvidia, Apple, AMD, Google, Amazon, all the big companies that I have. And of course, I have some other stocks as well, which are some other high beta names that we'll take a look at, like Palantir, Robinhood, SoFi, MU, Intel, all these other tickers here as well. So if you want to learn exactly what I look for, how I mark out the charts, I do a pre-market prep every single morning on YouTube at 8 a.m. Eastern Standard Time. So if you do want to join me for free, absolutely every single day on exactly what I look for coming into market open, you can do so on my YouTube, as I mentioned, every single weekday at 8 a.m. Eastern Standard Time. Now we understand the basics of TradingView. What do we have on the charts? And as you can see on the chart, we have so many candles. We have down close candles, we have bullish candles, we have bearish candles. What are these candlesticks? So the basic fundamentals of the markets is that we have bullish and bearish candles. As you can see on the right hand side, what we have here is a bullish candle. Where price opens, we end up pushing lower, sellers step in, but ultimately the buyers push price all the way back towards the upside. We create a high, and then we end up pushing back towards the downside, and we close. So you can see the market opens, creates a low, high, close, and this is a bullish candle formation. What matters here primarily is the open and the close. Anything in between, of course, is a lot of noise. The open and close is what's going to determine if it's a bullish or bearish candle. And the same thing to the downside. What we have here is an open, a high, low, close. So we create an open, buyers originally push this up, then sellers step in, push this all the way to the downside, and then we end up having a close in the markets. So as I mentioned, your open and your close is what matters, and this is what makes up a bearish candle. We have your open and we have your close. If the closing price is below the opening price, it's a bearish candle. If the closing price is above the open price, then that's what's a bullish candle. So this is the overall basic foundation of the markets. So as we head back onto the TradingView chart, as you can see right here, I have the candlesticks marked out on my chart. They're in a little bit of a different color. I have them in gray and black just because I like them color coded a little bit differently. You can right click and click on the settings and customize it to your liking. But as you can see, there's so many different candlesticks on the chart. As I mentioned, all these candlesticks represent are buyers and sellers in the markets. Currently, we're on the silver chart, and you can clearly see that the buyers have been in control for the past 3 months. Silver has had an explosive move towards the upside. And based off this information, we're going to be looking for different types of chart patterns that can give us a potential edge in the markets to capture moves like this. And before we do that, let's first talk about our psychology and why psychology is so important when it comes to trading. So before we get into my bread and butter system, let's first talk about some misconceptions and some hard truths when it comes to trading. Hard truth number one is trading is not a get rich quick scheme. A lot of people come into the markets looking to make quick money, but you realize very fast, the faster you make the money, the quicker it leaves. When you're focused on making money, you're never actually focused on the process, on actually how to make the money consistently over the long run. So you need to rewire your mindset to think in terms of focusing on the process to get the money and not actually focusing on the money itself. Number two, trading is not an overnight success. You see so many things on social media showing you crazy profits profits, showing you fancy lifestyles, right? What you have to understand is that it's not an overnight success. You might see the final product, but what you don't see is the nights of hard work, right? The years of sacrifice it takes in order to become a profitable trader. So when you first start trading, do not compare yourself to someone else because they might be at level 100, whereas you're at level 1. Number 3, not a lucky trade. When you come into the markets, a lot of the times you will get what's called euphoria. You will get a very lucky trade, and that's what hooks you into the markets. And a lot of times that builds what's called false confidence because you enter in the markets thinking it's very easy, that you're going to make a lot of money. And what happens after that? What happens is that you usually over leverage, you think you're better than you actually are, and you end up losing your money. Another hard truth, it takes making mistakes. Trading is all about making mistakes and learning from it. It's just like anything else. And in trading, you're going to make a lot of mistakes. So get ready to make mistakes, get ready to lose a lot of money. But the main thing, as I mentioned, is learning from those mistakes and improving, and countless hours of learning. What is very important when it comes to trading is the triple E's: education, execution, and experience. When you first start trading, you need the education. You need to be on the books. You need to be on the screens. You need to consume as much content as possible to get the system and foundation down. Then you need the experience, which is screen time, looking at the markets in real time. And then what you have is execution, is following your game plan. And that's when you're going to become successful. When you execute on a daily basis, once you have the experience and education down. So with that being said, we went over some misconceptions when it comes to trading and some hard truths. Now let's go on to my favorite part, which is my bread and butter strategy. So now that we went over the core foundation of what it takes in order to become a profitable trader, I want to dig a little bit deeper into what I believe are the 3 core principles on what you need to succeed in the markets. The first thing that you need is a proven system and strategy. When you come into the markets, you need what's called an edge in the markets. And having an edge is also having a positive expectancy. So over a long period of time, you're expecting to gain something from the markets. In this case, you're looking to gain an edge in the markets, which means make money over a long period of time. So this is what every trader needs when you first start trading. Next is having solid risk management. Without solid risk management, everything else goes out the window. You need solid risk management in order to become a profitable trader. If you don't have solid risk management, you can lose your whole account within a few trades. So understanding and following solid risk management rules is going to be key when it comes to trading. And finally, what I have here is consistency. So after you have a proven system and strategy, you have solid risk management, the rest is just consistently doing the same things over and over again and following your plan. So consistency comes from experience, execution, and education. Once you have all those 3, it's about repeating it over and over again. So now with this being said, let's hop right onto the trading view charts, and I'm going to show you guys exactly what my system and strategy looks like that I use every single day. So as you can see right here, I'm currently on the trading view chart and I'm on gold futures. What I'm about to say here applies to any sort of ticker or instrument. So you can be trading options, stocks, futures, forex. It's all the exact same thing. And as you can see in the charts right here, what we have is candlesticks. So the market is made up of a bunch of candlesticks on the charts. And the candlesticks, as I mentioned earlier, represent buyers and sellers. So as you can see, we have a clear uptrend in the markets indicating that buyers are in control and we have a really strong push towards the upside. Right here, you can see we have a little bit of a pullback, but then buyers step in once again and we end up pushing back towards the upside. So as you can see right here, the markets are made up of buyers and sellers. And our job as traders is to be able to identify these key areas where buyers and sellers are present, where we could be looking to take trading opportunities off of. So in the most basic sense, what we're looking for is for price to come back down into key areas of support where we can be taking long positions back towards the upside. And then price also comes up into key areas of resistance where potentially we can be looking to sell for price to push back towards the downside. So we're just looking for key areas of support and resistance for buying and selling opportunities. So right now I'm going to show you a line illustration of exactly what the basics of my strategy and system is. So let's say right here we have this green box, which is a key level of support. And I'm going to draw out a key level of resistance, which is going to be a red box. So let's say, for example, price is right in the middle. Where are we going to be looking for buying opportunities? Let's say price comes back down in towards our green box. Now what we want to be doing is looking for trading opportunities to trade this back towards the upside. We want to see if buyers are present off this key level support to push this back towards the highs. And let's say price keeps moving higher, and now we come up into our resistance level, right? We do not want to be buying up at this resistance level. What we want to be doing is looking to either take profits, or we're going to look to sell for a potential push back towards the downside. So essentially how the markets move is they're going to move off these key support and resistance levels. And our job as traders is to be able to identify these levels to take trades off of. So in the most basic terms, we want to be buying at support and selling at resistance, or we want to be selling at resistance and buying at support. So this is the very basics of support and resistance. What else can we do? Let's say, for example, what we want to do is capture trends in the markets. So instead of buying at this key level of resistance, what we're going to do and wait for now is a potential break above this resistance. So the way I trade is I like to trade trends in the markets. So right here, we can kind of see we're in a range, but what we want to see is a break outside this range and continuation towards the highs. So the way I like to trade is to capture trends in the markets, and I'm essentially looking for the break above this resistance, a retest of this level for this continuation higher. So how this works is when price comes up into a key level of resistance and there's no sellers present, and we actually end up breaking towards the upside. Now, since we're showing strength, we're breaking above this key level of resistance. Now this level of resistance we want to see turn into support. So we break above, this was our previous resistance level. Now we turn into support for this continuation higher. So this is what's called the break and retest. And the break and retest works best in trending markets. And where do you make the most money when it comes to trading? In trending markets. It's a lot harder to trade when you're inside of a range. So that's why we want to specifically be focusing on capturing trends, because capturing trends are a lot easier. And when you ride trends, that's when you're going to make the most money. So with this being said, now we understand the basics of what support and resistance is, what the break and retest is when capturing trends. I'm going to go over some higher time frame patterns that I love to identify on the higher time frames, specifically when trading in trending markets. And these three patterns are my bread and butter and what I look for every single day. And if you see these on the higher time frames, make sure to pay attention, because this is what's going to make you the most money in the markets. So as you can see right here, what we have is the trend continuation. And this is one of the most powerful patterns that you can identify on the higher time frames. And what does a trend continuation look like? So it's essentially identifying a higher time frame trend here in the markets. And what does this mean? All you're looking for is higher lows, higher highs, higher lows, higher highs, higher lows. And when this happens, this is what's called an uptrend in the markets. The same can be applicable to the downside, but we're just looking for a clear trend. Once we get this clear trend form, all we're looking for is the previous level of resistance. So at one point, this level was resistance. You can see price rejected and continued lower. But once we're able to break above this key level right here, which is essentially your break of structure, this is now a clear uptrend in the markets, because we're forming higher lows, we're forming higher highs, we're forming higher lows, and now we're forming higher highs once again. So this is a very clear sign that price is continuing higher. And now all we're looking for is this level of resistance to now turn into what I call support. So this level should now be used as support, and this is exactly where the buyers should step in for this continued push towards the upside. So this is what's called the trend continuation. This is one of the most powerful and basic patterns that you can see on a chart. And as I mentioned, the same thing applies to the downside. So if we're making lower highs in this case and lower lows, we're breaking underneath a key level of support, and now this level is turning into resistance. This is exactly where we want to be looking for sells for a push back towards the downside. So the exact same thing applies here. Both the logic is same on both sides, but this is exactly what you want to be looking for, trends in the markets. Next, what we have here is what's called our range break. So a range break is very powerful because the market is ranging majority of the times. And as I mentioned, what we want to be capturing is trending markets. So what we want to do is avoid trading the range, and we want to be trading trends. So for example, let's say we have a clear level of resistance and we have a clear level of support. So let's say price is in between the middle of the range and we're bouncing off support, we're rejecting off resistance, bouncing off support, rejecting off resistance. And as you can see right here, what we have is a clear range in the markets. A level of support is being defended, resistance is being rejected off of. You can see we're clearly in a range, which is our resistance level and our support level. What we want to do here is avoid trading inside of the range, because what we can do quite often is get shopped around because price is bouncing, it's rejecting. It's very hard to identify what the market's doing, especially when it's ranging. So what we want to do here is wait for what's called a range break. What we want to do now is wait for a clear break above this level of resistance. Once we break above this level of resistance, now what we can be doing is using this level of resistance turn into support for this continuation towards the upside. Now we can be looking for buys. Instead of buying up in towards this level of resistance, we want to be buying once price is above, since this looks a lot better because now we're showing that buyers are present. The same thing to the downside. If we want to be looking for shorts, we don't want to short into a level of support. We want to be waiting for the break underneath, the retest of this level, and then look for sells underneath our level of support, now turn into resistance for continuation towards the downside. And this is very powerful. It's a lot easier to identify in hindsight, of course, but we'll go over some examples to show you guys exactly what this will look like in real time. And one of my favorite chart patterns is what's called the flat top. And this is one of the most bullish patterns in a trending market, specifically to the upside. So what we're going to be looking for is a clear push higher. And as you can see, the markets are what's called building up higher lows. So as you can see, we're building up higher lows, but we have this clear level of resistance. But the markets are making higher lows, as you can see right here. What we're going to be looking for now is the break above this flat top. So this flat top here, as I mentioned, is a clear level of resistance. You can see sellers are stepping in once again, and sellers are stepping in the third time. But as I mentioned, the markets are building up these higher lows. So once we can break above this flat top, we can expect continuation towards the upside. So this is a very powerful chart pattern. Now all we're doing is waiting for the break above, and usually this has a very explosive move higher. And what we want to be doing is capturing this leg in price, or we can be looking for, of course, that retest once again for that continuation towards the upside. So this is what's called the flat top break. This is one of the most powerful higher time frame patterns that you could be looking for, specifically in a trending market. So now with this being said, let's hop right into the charts to see exactly what this will look like. So as you can see, we're currently on the chart. We're on silver here on the hourly time frame, and as you can see, we're clearly in an uptrend in the markets. We're making higher highs, higher lows, higher highs, and we're pushing towards the upside. As you can see, we are in number one, a clear uptrend, and now we're using these clear levels of resistance now turning into support levels and pushing price back towards the upside. What we have here on silver is this clear level of resistance, so we can mark this out and drag this over. So as you can see right here, based off this chart, we're building up higher lows in the markets. If you want to see a trend continuation, what we like to see is a break above this key level of resistance, and then we'd like to see this area turn into support for continuation towards the upside. So let's play out the tape to see what happens. So as you can see right here for silver, we're getting that really impulsive push towards the upside. Now what we like to see is the retest off this key level of resistance now turn into support for continuation back towards the upside. So as you can see right here on silver, we're now coming back to that retest level. This is exactly where we want to see if buyers are going to step in. What we don't want to do is chase price as it breaks out. We always want to wait for the retest. The retest is going to be the lowest risk to reward in the highest probability area to look for price to continue back towards the upside. And as you can see, silver perfectly retested our level and continued back towards the upside. So you can see how this trend continuation is. I'm going to talk a little bit more about our intraday setups and exactly what we look for. But as you can see, just based off this chart, these are going to be the key areas in price that we should keep an eye out on. And of course, we want to be looking for entries as close to this retest level as possible, looking for that continuation back towards high of day with the lowest risk possible. I'm going to talk about risk to reward later in a bit, but this is exactly what we want to be looking for on a day-to-day basis. All right, so we're back on the silver chart once again, and we're back on the 15-minute time frame. And as you can see right here for silver, I consider this a range here on the 15-minute chart. We're rejecting off our key levels of resistance. We're bouncing off our key levels of support. So I consider this a range here in the markets. And since we're in a range, what we want to be doing is waiting for a break outside of the range. So we either want to see that break above for that continuation towards the upside, or we want to see a break below for that continuation towards the downside. So these are the levels that we can have marked out. We can draw this over, and now let's wait for the tape to play out. So as you can see right here, we're now breaking towards the upside. We have an impulsive move higher above our key level of resistance. Now what we want to do is wait for the retest off our 86,000 for this continued pushback towards the upside. As you can see, price is now coming back to retest our key level of resistance, now turn into support. As I mentioned, you don't want to chase the breakout. You always want to wait for the retest. There are certain circumstances where you can be looking for the breakout trade, but what I'm teaching you here is the break and retest, which has the lowest risk with the highest reward possible. So this is exactly where we want to be looking for longs, with stops just underneath, looking for that continuation back towards the upside. Now we have this marked out as well, which we can be used as potential targets, which is our key level of resistance. As you can see right here, silver ended up holding that retest level perfectly and gravitated back up and towards our key level of resistance here. Now that we're above this level, now what we like to see hold is really this 89,000 for this continuation higher. So you can see that we're in this trending market here now on silver. We're making higher highs, higher lows. We're making a brand new high, breaking structure towards the upside. We really want to see this level hold now for this trend continuation. So we went from a ranging market to now a trending market, and you can see how powerful this strategy works. Let's see if we can use this level as now support. And as you can see, price beautifully touches our key level exactly where it's supposed to and has another leg towards the upside. And as you can see, this is exactly what we're going to be looking for, is clear trends in the market. As I mentioned, we want to be capturing trends because it is a lot easier to capture trends in the markets than it is to trade in ranges and consolidations. So we always want to be looking for trends. We can either be looking for the trend continuation, the range break, and now we're going to go on to my final one, which is my favorite, which is the flat top. So as you can see right here, we're back on the gold chart. We're on the 4-hour time frame. And as you can see, the overall markets are building up higher lows once again. You can see we're building up higher lows, but we're creating what's called a level of resistance. You can see there's a touch here, touch here, touch here, touch here, but we're building up these higher lows here in the markets. So this is very bullish because once we can break above our key level of resistance, there's a good chance we have some solid continuation towards the upside. So the level that we can have marked out is this key level of resistance. You can see liquidity is being built up. So the more times we reject off this level, once we break above this level, there's a greater chance we're going to have a more explosive move. So let's see if we can get that break. As you can see right here on gold, we're having that super strong break towards the upside here. Now you can see we have multiple touches, strong candle closure, impulsive move towards the upside. Now what we're going to be doing is looking for the retest off this level for this continuation higher. So as you can see here on gold, we have that nice impulsive move towards upside. We come back and retest this level, taps in. You can see buyers are stepping in aggressively off this level. Now we'd be looking for this continuation back towards the highs. And you can see right there on gold, we end up having this super solid break and retest on the 4-hour time frame. Buyers stepped in exactly where they're supposed to. We create another flat top here, and then we end up having this next leg towards the upside. So you can see right here, just based off of the higher time frames, so you can see how powerful these trends are in the markets. If you can look for trend continuations, range breaks, flat top breaks, the main purpose here is capturing clear trends on the higher time frames. So with that being said, now we understand the higher time frames. How can we use these patterns to our advantage? And now I'm going to be showing you guys some intraday setups that are my personal favorites. I'm going to go over 2 intraday setups that we use on a day-to-day basis, and then I'm going to go over plenty of examples here as well. So now we're going to go on to 2 of my favorite intraday setups, starting off with the previous day highs and previous day lows. So what we're going to do is mark out one single daily candle. This forms every single day here in the markets. If you scroll down, you'll be be able to see a bunch of these daily candles on the charts. And all these daily candles consist of one full day's worth of price action. So what we're going to do is mark out the previous day high along with our previous day lows. So these are going to be key levels when coming into the market open. And all we're simply looking for is the break above our previous day highs, a retest of our previous day highs for continuation towards the upside, or a break below your previous day lows, a retest of this for continuation lower. So as I mentioned, we're looking for the previous day high retest for a push towards the upside, or the previous day low retest for a continuation lower. And the next setup we're going to talk about is fairly similar. It's called our opening range break and retest. And the opening range break and retest is almost the exact same thing, but on the lower time frames. So when we're talking about the previous day high and previous day low, we're talking about one full daily candle. When we're talking about the opening range break and retest, we're talking about the 1, the 5, or the 15-minute time frame that we're going to be using. So for example, a very common time frame that we use for the opening range break is the 5-minute chart. We're going to wait for that first 5-minute candle to form at New York Open at 9:30 a.m. Eastern Standard Time. What we can do is mark out that 5-minute opening range high along with that 5-minute range opening low. And what we're going to do is look for the similar thing, a break above for this continuation towards the upside, or now we're going to be looking for the break below our 5-minute range low for this continuation lower. All we're doing, as I mentioned, is looking for trends in the markets. We're looking for clear breaks of resistance for continuation higher, or clear breaks of support looking for continuation towards the downside. Now let's go into some examples to see exactly what this will look like. So as you can see right here, we're on the Nvidia chart here. We're on the 15-minute time frame, and what we're going to mark out is key levels here. So as you can see on the charts, we have a clear level of support which can be marked out at this key area, which is this 184. You can see how many touches we have off this level. It also coincides with our previous day low here as well. And what we like to see coming into market open, if we want to see some upside, we need to see the bounce and mean reversion. But as I mentioned, what we're looking for here is trends or a potential range break. So if we can break underneath this range, which in this case is also your previous day lows, and retest off this level, we could be looking for continuation towards the downside. So now let's go into lower time frames to see if we can get that break. So as you can see right off the bat here on Nvidia, we're breaking underneath our previous day lows. We're also breaking underneath this range here on the higher time frames, which happens to be our 184. Now what we're going to be looking for is the retest off that previous day lows for this continuation towards the downside. So as you can see right here on Nvidia, we're getting that push right back up and towards our previous day highs. We have a strong rejection candle here as well. The next candle breaking underneath its previous candle. This is exactly where we can be going in short. So as you can see right here, we're entering short here on Nvidia off your previous day lows. We can enter in off this candle right here after the rejection. We can enter in on the next candle. In this case, our stop can be just a break above, looking for that continuation towards low of day and below. We're just going to mark out a nice 1-to-2 fixed risk to reward ratio just to make it nice and easy in this case. So we can be looking for continuation towards the downside. Now let's play out the tape. And as you can see right there on Nvidia, we end up having that nice push towards the downside to hit our take profit. And that was the exact level we kept an eye on, which was your previous day lows. So you can see we had your previous day low retest. We also had that range break retest as well, which made it higher probability that Nvidia was most likely going to continue towards the downside. Now let's go on to the next example. So as you can see right here, we're on our next example, which is AMD, and we're clearly in a downtrend. We're making lower lows, lower highs, right? Lower lows, lower highs, and we're continuing to push lower. You can clearly see that we're in a downtrend just based off the market structure. So coming into market open, what we're going to be looking for now is the break underneath our previous day lows for this continuation towards the downside, just based off the trend in the market. So the levels that we can have marked out in this case is going to be our previous day lows 208, and now what we want to do is see continuation lower. Other levels we can have marked out is this 212. You can see nice low that we created, break underneath, retest, and now what we want to see is just continuation towards the downside for this push lower. Now let's play out the tape. So as you can see right here on AMD, the first 10 minutes of market open, nice push towards the downside. Now we're breaking underneath our previous day lows here as well. So what we like to see is a retest off that 208 for this continuation towards the downside. So as you can see right here on AMD, we're breaking towards the downside. We're retesting our previous day lows, retesting this candle right here as well. We have this confirmation candle that price wants to continue lower. Once this candle closes underneath its previous candle, this is exactly where we can go look in short with a stop just to break above. And now we can be looking for low of day plus a 1 to 2 fixed risk reward ratio. Now let's play out the tape. And as you can see right there on AMD, we end up having that nice rejection right off that previous day lows. Price got back underneath key levels once again, and we end up having that super solid continuation right down in towards our take profit. So this was another great example of using that previous day low retest. We also used that trend continuation on the higher time frames as well, which gave us extra confirmation that price did indeed want to continue lower. So as you can see, we're on our next example here. We're on Intel. You can clearly see we're in a clear trend towards the upside. We're making higher lows, higher highs, higher lows, and we're continuing to push higher. So in this case, since we're gapping up here in the pre-market, some of the levels that we can have marked out is going to be that previous day highs, that 45.40. You can see multiple touches on this day, multiple touch in its previous day, multiple touches here in the pre-market. What we like to see here is that previous day high retest for continuation towards the upside. So the higher time frame is bullish in this case. The lower time frames were above our previous day highs. So let's look for that previous day high retest for that continuation towards the upside. So as you can see right here on Intel, we're coming right back down in towards our previous day highs. Buyers are clearly present here off our previous day high key level. Buyers are stepping in. We have this nice confirmation candle here that price wants to continue back higher here as well. We can get in on this candle with our stop just to break below. And now what we can be looking for is high day plus continuation back towards the upside. Of course, our risk level, we want as close to our previous day highs as possible. So we can get in as this candle is forming, can get in as the buyer are stepping in off our previous day highs. The entry confirmation is just dependent on how much confirmation you want to wait for and if you want a higher risk to reward or a higher win rate. But let's say we get in on this candle close with a stop just a break below here. Now what we can be doing is looking for high day plus continuation back towards the upside. And as you can see right there on Intel, we end up having that nice push up and towards our take profit. Higher lows were built off of our previous day highs. And then we had that nice push up and towards our high of day. And of course, above here as well. And this was another great example of using that previous day high retest in combination with our higher time frame trend continuation. So with this being said, now let's go on to some other examples using that 5-minute opening range retest. So as you can see right here, we're on NVIDIA once again and using the 5-minute opening range retest. So what we're going to do is mark out that first 5-minute candle high and low. Once we have this first 5-minute candle established, what we want to do is wait for that 5-minute range break above for that continuation towards the upside, or now it's going to be the 5-minute range break below, retest for that continuation towards the downside. Once we have these levels marked out, now we can go on to the lower time frames on the 1-minute time frame. So as you can see right here, we're now breaking underneath our 5-minute range low here on the 1-minute time frame. Once we have that 1-minute candle closure, now what we can be looking for is a retest off this 5-minute range low for this continuation lower. And as you can see right here, NVIDIA is now retesting our up close candle. We're also retesting this 5-minute range low here as well. We have this nice confirmation candle that price does want to indeed head towards the downside. This is where we can go looking short with a stop just to break above. And now what we can be looking for is continuation towards the downside and below. Now let's play out the tape. And as you can see, we end up having that nice push all the way down and towards our take profit right off that 5-minute range low, plus the confirmation candle right here as well with a stop just to break above our 5-minute range high, looking for that nice continuation towards the downside. So this was a great example of how to use that 5-minute range low. So as you can see right here, we're on our next example, which is on the QQQ. Coming to market open, we're underneath our previous day lows. We also have that first 5-minute range high and low played out. If we do want to see some upside here, we need to see the break above our 5-minute range high, could retest for that continued push towards the upside. Or now what we like to see is a break underneath our 5-minute range low, retest of this for that continuation lower. So now let's mark out our key levels. We can have marked out our 5-minute range high plus our 5-minute range low. If we like to as well, we can kind of extend this up and towards our previous day lows just to make this a general area that we need to reclaim. Now let's go on to the lower time frames. So as you can see right here on the QQQ, we're actually having nice rejects off our previous day lows. This could have been an area you could be looking for continuation lower, but now we're breaking underneath our 5-minute range low here as well. So let's see if we can use this level now as a retest since we have that weak candle closure, a lot of displacement. Now let's look for that retest off our up close candle for that continuation towards the downside. So as you can see right here, QQQ, nice retest right off that 5-minute range low and this up close candle. Super strong confirmation candle here as well. This is exactly where we can go looking short with a stop just to break above. And now we can be looking for continuation towards low of day and below. Now let's play out the tape. And as you can see there on the QQQ, another nice push right down in towards our take profit, right off of our 5-minute range low. Also another rejection off our previous day low. So this ended up being a great example of exactly how to use not only the previous day lows, plus that 5-minute range low as well for that continuation towards the downside. So with that being said, that was a basic overview of exactly how I use my system and strategy. I have plenty of different videos on these individual setups. So if you do, make sure to scroll through my channel. Also link some videos that you can check out in the description below, of course. And with that being said, now let's go on to the next portion of this video. And finally, let's talk about risk and money management. Without proper risk management, nothing else matters. You need to be a good risk manager when it comes to trading because ultimately you can have a bunch of winning trades. You can have a great strategy, but if you cannot manage risk properly, you can lose that all in a heartbeat. So understanding money and risk management is very important when it comes to trading. And one of the most common questions that I get asked when you first start trading is how much money should you trade with? Very basic question. And there is no answer that fits all, but the one answer that is correct is money that you can afford to lose. When you come into the markets, a lot of times you're trading with money that you can't afford to lose or that you don't want to lose. Let's say, for example, you need that money to pay bills, to put food on the table. If you're using that money to put into the markets, there's a good chance you're going to lose that money because in the back of your mind, you're always thinking and questioning every decision that you make because it's money that you can't afford to lose. But at the end of the day, you want to be able to put money that you're comfortable with losing, that you can actually treat this as a business and that you can trade based off of probabilities and not off of emotions. So let's first talk about the very importance of money management, and it's understanding how the trade works. So in every single trade, we're going to have an entry, we're going to have stops, and we're going to have targets. This is every single trade. So we enter in a trade, there's only two outcomes. We're either going to hit our stop loss and we're going to lose money, or we're going to end up gravitating towards our target and we're going to make money. So there's only two outcomes in this case, our stop and our target. How do we manage risk and what's important? What we have to understand is risk to reward. So what we're risking in this case is what's going to be called our R multiple, other known as our risk amount. So this is how much we're risking on any given trade. So let's say, for example, this is going to be $100. Now what we have is our reward. What do we want to make for our trade? So first we have to understand our risk, and then based off our risk amount, we can calculate the reward because risk is what we can control. What we can't control is the reward. So what we want to figure out is the variables that are in our control, which is the risk amount, versus the variables that are out of control, which is the reward amount. In other words, what's our stop and how much we're willing to lose, and what's our target and how much money we're willing to make. So what I always go by, and what's a great rule of thumb, is that for every single dollar we risk, we want a minimum of 2R. So our risk amount in this case, for example, let's say 1R in this case is our risk amount. So usually the standard metric for risk is 1R. That's how much we're risking. So in this case, let's say, for example, we're risking $100, which stands for 1R. Our reward and what we want to make is at a minimum of $200. So we want to risk $100 to make $200. And that's going to be a great rule of thumb on how we like to trade, at least the break and retest and what we look for on a consistent basis. So we want to risk 100 to make 200 or potentially more. We don't want to be looking for one-to-one trades. We always want to be risking 1 to make 2. And one of the biggest misconceptions when it comes to trading is that high win rate equals success. A lot of people think that when you win more, you make more money, but that's not always the case because some people, they can lose more than they win, but they're actually more profitable. And it's based off of this chart right here, which I love to show. It is a risk to reward / win rate cheat sheet. And as you can see right here, what we have on the left-hand side is our risk amount. So we have our risk amount, and on the top, what we have is our win rate. And just by looking looking at this cheat sheet right here, you guys can take a screenshot of this. This is going to be very important. So where I fall under is anywhere between a 40 to 60% win rate in a given month. On slower months, I'm right around that 40% win rate with around a 1 to 2. And on months where the market is more volatile, there's more continuation, I'm closer to 60% at a 1 to 2. And you can see if you lie anywhere in the green area, which is the profit area, that means you have an edge, and that means you have a positive expectancy in the markets. If you fall underneath the red area, which let's say, for example, you have a 40% win rate with a 1 to 1, that means you're a losing trader. So you want to be in the green area, which is just understanding the difference between risk to reward. As I mentioned, when you're trading the break and retest, depending on certain market conditions, depending on the entry models that you take, you can be anywhere between a 40 to 60% win rate, around a 1 to 1.5 or a 1 to 1.2 risk to reward ratio. This is my stats over years of trading the break and retest. So this is something you can keep an eye out on. And this brings me to my last point, which is having a trade journal. You want to be able to track your statistics and understand hard evidence and hard numbers, because that is what matters at the end of the day. Trading is all about numbers. It's all about math. The way you make money has nothing to do with your emotions. It has everything to do with numbers. So being able to track these numbers is very important. And you can do this through trade journals. Right now, I'm using TradeZella, TraderSync. You can use Notion. You can use Excel. There's a bunch of different journaling softwares out there, but it gives you a great indication of a variety of stats that you can have, like your net P&L, your trade win percentage, profit factor, day win percentage, average win to loss ratio. This was my month back in November, one of my biggest months of the year. And as you can see, it gives me a bunch of stats that I can take a look at, which is very important that I can go back and track. So it gives me a great indication if I'm trading well, if I need to improve on certain things. So this is tracking hard data. You also want to be tracking your emotions as well. So you want to go back, track each individual trade, understanding how you're feeling during that trade. You can record your live sessions. There's a bunch of different ways to journal, but as long as you're journaling and you're going in depth and reviewing all your statistics and finding out what you're doing right and what you're doing wrong. When I first started trading, I actually never journaled because I thought I could just keep everything in my mind, but I was clearly wrong because I was basing it off of emotions and I wasn't basing it off of actual statistics. So with that being said, I want to go over one more slide here. And what I want to mention is that success is not linear. When it comes to the markets, most people think that success moves up in a straight line. And success actually looks a lot like a very healthy chart. There's going to be, right, plateaus, you're going to have dips, you're going to have leaps, plateaus, dips, leaps once again, right? It's essentially building up a very healthy chart, making higher highs, higher lows, higher highs, and higher lows, right? It's never going to be linear as most people think. Of course, we want success to look like this, but at the end of the day, there's so many different variables when it comes to trading that it's never going to move up in a straight line. And that's the exact same thing, not only in trading, in life. What we have to understand is that as long as we're moving in the right direction, that's what all matters. As long as you put the time and effort into trading, and at the end of the day, as long as you never give up. So with that being said, I hope you guys enjoyed the video. If you did, appreciate it if you guys drop a like and sub, and I'll see you guys next week for a brand new video. Peace.